Stacey, welcome back to the Financial Markets Quality Conference at Georgetown. We are delighted to have had the partnership with the New York Stock Exchange and the Georgetown Center for Financial Markets and Policy for many, many years now. So thank you.
Thank you, Reena. Thanks for having me back, and welcome to the NYSE.
So Stacey Cunningham is the president of the New York Stock Exchange Group, which includes the New York Stock Exchange and a diverse set of equity and options exchanges. And New York Stock Exchange is a wholly owned subsidiary of the Intercontinental Exchange. She is the 67th president and the first woman president of the New York Stock Exchange in its 229-year history. Before this, Stacey Cunningham was the COO of the New York Stock Exchange Group, where you headed the equities, derivatives, ETFs, all kinds of businesses, and you started on the trading floor. Right?
A long time ago, a really long time ago.
Things have changed a little bit.
Yes.
So, but Stacey, it was September 13th that you came back to do your first opening bell ceremony after COVID. And it was also interesting, it was a SPAC that was going public, and they did the opening ceremony on that day. And before that, you had to close down the floor of the stock exchange. And I'm sure you had practiced all of this many times and thought about business continuity, but how was it in real life to go through all of these changes?
Well, it's interesting, and you mentioned September. September is when actually we rolled out our vaccine mandate, but we only closed the trading floor for 9 weeks. So we had reopened in May of 2020, and the first company that came in to ring the bell then, one of the CEOs called and said, I don't care if I have to wear a hazmat suit, I'm coming in and I'm ringing that bell. So we learned very quickly that we were going to have to find a way to safely welcome people into the building and celebrate those important milestones. I mean, an IPO is such an important milestone. But fast forward to September of 2021, and it was an interesting moment. There were so many things highlighted when you think about vaccine mandates and SPACs going public, and it really was representative of so many of the elements that we had to put into place, and what we've learned from those experiences over not just the past 18 months, but really getting ready for those moments. It's events that we went through as an industry years ago that put us in a place where we were able to shutter the markets and physically and close our offices and close the trading floor and still run as an industry all of the markets really, really well in March of 2020. And that's a testament to the work that we put into it. And some of those projects are not the most glamorous technology projects to be working on. When you think about your business continuity planning, you don't test those live, you don't get to see it, and it's not quite as exciting, but it's critical. And it was really tested, the industry as a whole was really tested, and we passed that test. And so I'm really excited to see what we can do when we put our heads together and deliver more resilience during times of uncertainty.
Absolutely. And just before COVID, you had written an op-ed expressing concern about the decline of IPOs. And here we are. 2020 was a smashing year. Who would have guessed? Right? Who would have? And 2021 continues to be a record-breaking year with companies raising millions and millions of dollars on the New York Stock Exchange. What happened?
Yeah, when you look back to March 2020 and you see that we were facing 1,000-point declines in the Dow Jones and major market moves, nobody would have expected that 2020 was going to be shattering prior capital raising records, and it did. And then 2021 surpassed those records, you know, just part of the way through the year. And so that is a shift in the trend that we're seeing with companies going public versus staying private, which is important because, as you mentioned, the point I was making in that op-ed is we can talk a lot about the reasons why companies stay private, but we don't spend enough time talking about what's the downside to that, what's the implications of it, and are we really recognizing what that represents? And there are a number of things. Companies are growing in the private markets to much larger organizations without the discipline and the oversight that comes from a public listing. And so there's a lot of good governance that comes from the public markets. And so companies are getting much larger. Sometimes their bad habits are growing with them because they're not just a startup that's getting their, learning the ropes. They're also, their valuations are not based on many buyers and sellers coming together with information to really value a company. It's based on just a handful or perhaps sometimes one investor setting that valuation, which the public markets then need to reprice. And so that's a concern as well. And when you also look at just the impact that has on access to opportunity. So our mission at the NYSE, I mean, you mentioned 229 years, some things have not changed. A lot has changed, but some things are the same. And our mission is still to help companies access capital so they can grow and expand their businesses. They go out and change the world, and they're creating opportunities for others to share in that success. And that second part is really important because we need to make sure it's a story of shared success. And when companies stay private for a long time and grow in the private markets, they're not sharing that success. And so not everyone gets that benefit. So we really want to see companies going public. We saw that when it became very expensive to raise money in the spring of 2020, when suddenly companies were worried about the future, just given what we were seeing in the early days of the pandemic. And it was so much more efficient to raise money in the public markets. And so I think companies who had stayed on the sidelines for a long time thought, uh-oh, I shouldn't always assume they're going to be ready for me whenever I need it. And then money was cheap. It was easy to raise money in the public market. So we saw this pendulum swing. We didn't expect it to be so sustained. Frankly, it surprised a lot of people that it continued to see so many companies going public. And companies have more choices now about how to go public. So it's a really good time in the capital markets, and it's exciting and what it means. I'm excited by also what it means for so many people and investors, including the class of retail investors that we've welcomed to the market in 2020 and 2021.
So companies raised capital and they went public in different forms, right? The traditional IPOs, but then SPACs took a life of their own, yes, and they had direct listings. So there's been a lot of that going on, but at the same time, regulators have been somewhat concerned about SPACs. Mm-hmm. They've been concerned about direct listings, raising capital with direct listings. How do you think about that?
Well, I think we need to recognize why companies are going public and what are their goals. And it's always important for all of us running a business to take a step back and say, what's changed and what are we trying to accomplish, and should we rethink how we're doing things? So this idea of direct listings really started with Daniel Ek, who's hanging on the wall over there, and he's the CEO of Spotify, and Barry McCarthy, who's the CFO, said, well, we're not going public to raise capital. Why don't we rethink how we do it? And so we worked with them on coming up with a direct listing and finalizing a plan that they could go public without raising capital. And that was a real innovation based on the fact that companies were going public for different reasons from what it used to be. And that's an important distinction. If you think about the value, the benefits of being a public company, access to capital, really efficient. Liquidity. So if you have early investors or employees that want access to liquidity, being public makes that much easier. Currency, so they can use their shares to engage in M&A. And also the credibility and visibility of being a public company. Those are all benefits. It used to be that companies were primarily going public to raise money. And that shift has really been significant. As we talked about, companies were staying private because they had access to capital, because they had alternatives, which means if they're not going public just to raise money, well, let's think about how they go public. An IPO is all about raising capital, selling shares to a subset of investors the night before, and then being public the next day. So a direct listing decouples that capital raising from going public, and it allows them to file their documents with the SEC. So they're still filing an S1 or an F1 for a foreign private issuer, and they're still meeting the standards of a public company, but they're just not selling shares the night before, and the market is pricing their shares, which that's just exciting to me as a markets person, as a markets nerd. You just think this is how it should work, that there should be real price discovery. We filed with the SEC to add a capital raise, to your point, on top of that, to say, what if a company does want to raise money at the same time, but they still like the idea of the market pricing that offering? That's where we received approval from the SEC to do that, but we've received some pushback on mechanics around how that would work. And so we need a company to really break that mold the way Spotify did with the capital raising, which is a little harder to be patient when you know you need to raise money at the same time. SPACs is a little bit different. So SPACs, in that case, you're negotiating with a counterparty. So you have a little more control. And what used to be, if you think SPACs aren't new, I mean, they've been around for a long time, but they were a mechanism for companies who weren't quite ready to go public or might have trouble getting public, it offered them an alternative path where a sponsor would help get them into the market. And that's really evolved as we've had more sophisticated sponsors launching SPACs. And that's become another way for a company to get public, and much larger established companies are choosing that path as well. Because the sponsors are raising money, and some of the mechanics around a SPAC are they have 2 years to find an acquisition to bring that company public. And after that clock expires, they need to give the money back to shareholders, which is why the SEC is somewhat comfortable with the structure. So their incentives are to find a company to get public. And that's where there's some concern. And when your incentives aren't necessarily, when there are conflicts within the incentives, we need to make sure that they're disclosed, that they're transparent, so investors have that visibility. There are a lot of mechanisms built in that protect investors, but those disclosures become a really important part of the process in order for investors to make the best decisions for themselves.
Yeah, it's a good thing that investors have the option to redeem.
Yes.
If they don't want to go through, they have a right to vote on the SPAC deal. So there are a lot of mechanisms built in.
There are, but when you're talking about over 400 SPAC companies live now looking for targets, they might be inclined to try and bring a company public that isn't really ready for the public markets in order to get their SPAC deal done. And that's where I think the SEC is a little bit concerned, and some of the investors are concerned that the incentive structure isn't necessarily in the best interest of investors if they're not reading the information that they're given, so that they know when to redeem and they can have full disclosures around the mechanics of a deal.
It's interesting. There are actually some academic studies, and they're showing how the SPAC structure has already changed in the last year.
Yes, and same with direct listings. So it's really, I mean, that's true of any innovation. When you see new innovation in the market, you start to see even some of the more traditional providers of technology or whatever service it might be rethink their own offerings in order to remain competitive. And so now you're seeing things like lockups on IPOs being renegotiated. You're seeing more disclosures be included in SPACs, more incentive structures that are long-term incentives to provide more balance. And so you're seeing a lot of those overlapping characteristics between direct listing SPACs and IPOs, which means companies have more choice than they've ever had before, and not just in how they want to get public, but what specific characteristics of a public listing are most important to them and fit their own business. It's not one size fits all, and it shouldn't be, because not all companies are the same.
You mentioned retail investors. So when I started teaching class at the beginning of this semester, I asked the students to raise their hand if they were familiar with some of the popular trading platforms that have emerged, and almost all the hands went up. And then I asked them, so how many of you have actually traded on these platforms? And a lot of hands went up. And I was thinking, what does this mean for financial literacy in the future? 10 years, 15 years, these kids are going to be so much more financial literate than sort of people 10 years ago.
Yes.
What are your thoughts on where is the retail trend going?
Anything that we can do to increase the level of financial literacy is a win. And that is really important for us as a society to make sure that we are doing our part to teach people about financial literacy, about how to manage and invest for their futures. That's so critical. To make blanket statements about retail investors, I think would be a mistake, just like it would be to make blanket statements about institutional investors. They come in all different, they have all different goals and time horizons. So with respect to the access and the democratization of access to opportunities, really important that we recognize there is a new class of investors. We want them to have access. We need to make sure that all investors have the information that they need. And that's what the regulatory environment in the US is all about with our markets. And that's one of the focuses of the SEC. It's one of the focuses of the New York Stock Exchange around disclosures and transparency, so investors have the information that they need to make informed decisions. We want to make sure that investors understand the dynamics and the risks in the market. And that is not a statement around retail investors. I think sometimes I hear responses, or perhaps I read them on Twitter, responses from retail investors saying, you don't need to protect us. And it's not about protecting that trader or that person who's looking to invest in the market. it's the category more broadly of all investors, and not all retail investors are equal, right? When we saw some of the activity in the meme stocks in January, very often I heard, well, we know what we're doing and we're okay with it, and we know we can lose money, and that's okay. Well, they're also trading against other retail investors who personally would send me emails and say, what the heck just happened? And like, I didn't know this was possible. I didn't understand what was going on. And so I need to worry about those investors too. And so to make a blanket statement about all investors would be a mistake. And so we need to put a framework in place that provides protections for investors of all sizes. And just like to say, you know, hedge funds have a certain goal would be wrong, right? I mean, there are different styles with different goals. And so literacy is certainly a big part of it. Education is a big part of it. Taking a step back and looking at what are the practices and shifts and trends in our regulatory framework and the market structure that exists today, and should we make changes based on how the markets have evolved? And the answer is always going to be yes. It always should be yes. And if we're not doing that, I think we're not doing our jobs.
So we've talked about IPOs and retail investors. Retail investors are still not getting huge allocations in IPOs.
Well, in a direct listing they are. It's one of my favorite things about a direct listing. It really democratizes access to that opening trade. And a retail investor is on a level playing field with the most sophisticated institutional investors out there. And they have the opportunity to participate from trade one in a direct listing. And that was really important too. And I talked about Daniel Ek, the CEO and the CFO of Spotify. The CEO is really focused on democratization of access, making sure the information that was being shared was available to all investors, not just those on the roadshow. And the CFO is really also concerned about the cost of capital. So if you sell shares in an IPO and it pops 100%, people say, great IPO. Well, two things there. If you're the one that sold it the night before, that's not great. And if you're the retail investor that couldn't buy it until the next day, because you're right, they don't get a large allocation in the traditional IPO format. And if they can't buy it till the next day, then they're missing that pop and that growth. So that's one of the things I love about a direct listing.
Yeah. I mean, it's great about direct listings, but you know, direct listings are tiny compared to all the SPACs and all the traditional IPOs that are going on. So somebody who's studied IPOs for the last 2 decades, I still find that the retail allocation is pretty tiny.
It is, and especially when you're thinking about consumer brands, when there will be a lot of retail demand and participation, that's part of what pushes it up the next day when there was not enough access to that opportunity. And direct listings are a very small part of the market, although increasing. And so I think it's interesting. I would keep your eye on the space, because we had one in 2018, one in 2019, you know, and now we've had 7 or 8. So it's picking up.
Okay. And so what do you think about what the SEC is looking at in terms of payment for order flow, gamification? How does they have a huge full plate between digital assets and market structure and ESG issues.
There's a lot happening in the markets right now. And so as Chair Gensler stepped into his role, he may have come in with ideas that he wanted to look at, or areas of the market he wanted to look at. And very quickly we saw the meme stock phenomenon. We saw a number of different things unfold that really led to additional questions and additional areas to be studied. So the SEC is taking an approach, talking to people. Look, there are a lot of researchers, economists, and academics within the SEC staff now that are studying the data to actually see what's behind some of these issues. They'll look at things like payment for order flow is certainly one that's been talked about a lot. Gamification. It's great to have retail investors. We don't want to take advantage of those investors. And so there just is some truth to that crowd mentality. And if we're leaning into that a little bit, we want to make sure investors are making the right decisions. So that'll be an area. ESG is definitely an area of focus. At the SEC, in corporate America, at the New York Stock Exchange, in so many places. So I do expect to see some rulemaking around ESG as well.
So if you had to ask the SEC or Congress to pass one piece of legislation or rulemaking that you think would help investors, do you have a wish list?
I think I always have a wish list, but I think what's really important is there is no silver bullet. There is no one thing that's going to suddenly make the markets the perfect format forever, right? Market's evolving. It's a living being, right? And when you have people, buyers and sellers, humans, coming together and making decisions, That's going to evolve. We need to constantly, and it takes us a long time to pass legislations and regulations. Once we do, we can't be done. We can't just say, you know what, this is going to solve the problem and we're done. And that's part of what we struggle with sometimes is some of the decisions we made in the past no longer apply the right way, and it takes a long time to evolve them. And so that's my ask would be, don't sit still and don't you know, we need to constantly be looking at, based on the facts today, what would we do and how should we evolve our markets? And there are certainly some legacy components. I mean, the fragmentation in the market is one of the problems that we have. It was implemented by design in order to create competition, which was the right thing to do when there wasn't a whole lot of competition. But the pendulum has really swung too far, and I think we need to address the fragmentation that exists today.
So, but talking about innovations that are taking place in the marketplace with respect to services, products, can we talk about digital assets a little bit? Yes. So ICE has been sort of at the forefront, right, and got involved in digital assets early on. What about the New York Stock Exchange? How are you thinking about digital assets?
Yeah, well, and so the NYSE took a stake in Coinbase, as you mentioned, back in 2015 or so, and that was really to learn, right? This was a new and evolving area. We wanted to understand it better, and so it clearly was an interesting part of the market. We launched Bakkt, which was, you know, and as you mentioned, NYSE is part of ICE. So when we think about where we're going to focus, it's really across the board. And so ICE launched Bakkt, which is a company that was designed to buy, sell, spend, and store digital assets. Started with the first physically delivered Bitcoin feature. Really evolved from there to be digital assets more broadly, which is where I think we're going to start to think about a lot of these things when you look at your airline miles and your hotel points and having a digital wallet where you can spend things. So that was the direction Bakkt went in. And we just went public on the New York Stock Exchange via SPAC to bring it all together and recently. When you think more broadly in the financial markets around the underlying technology and all of the different components that exist when you talk about cryptocurrencies, certainly we're going to see regulation come together. And we talked about the full plate that the SEC has, but cryptocurrency will certainly, I would expect to see some framework around that, which will help determine how disruptive will it be and what innovations can we take from that. And so as a very highly regulated exchange, we're not going to be, you know, we're not going to color outside the lines with respect to the regulation that exists today. So, you know, there were some statements that the SEC had made early on in the cryptocurrency days, which made it clear that we need to see what the regulatory framework is going to look like before we're listing tokens. But certainly digitizing investments is coming. That's definitely an area of the market, and we're closely, you know, obviously having a lot of conversations about that.
Yeah, I find it fascinating that the private sector is moving ahead, and you see now trillions of dollars worth of digital assets, but even though there has been a lot of regulatory push from many different regulators, and yet it just continues. So it's going to be interesting to see when regulators do provide some clarity, what that does to the market.
Yeah, where it's not new that regulation would follow innovation. Think about automobiles. You didn't have seat belts right away. You didn't have a lot of the safety mechanisms, and for 20 years until after they were introduced. What's really interesting is sort of the crowd force behind some of these initiatives, and looking at, I mean, I talk about automobiles and the safety mechanisms, but then you look at ride sharing, which was not necessarily a regulated industry, and by the time the regulators caught up to that, it was really a widely adopted service, and so it became more of a tweaking around the edges, and that might be where this goes too.
I want to turn to ESG. Let me start with the S part. So NASDAQ came out with new rules about board diversity. Where's the New York Stock Exchange on this?
I love this question because we do have a different perspective on it, but diversity is so core to us. I mean, you mentioned I'm the first woman sitting in my role. How could I not be focused on diversity? We launched almost 3 years ago, two and a half, 3 years ago, the NYSE Board Advisory Council. Our approach to diversity is delivering solutions based on the power of our community so that we can drive the change we want to see. And so what we did was we brought together the council. It's 20 CEOs of NYSE listed companies. We tap into their networks and ask them to give us diverse candidates that they would vouch for and recommend to sit on boards, so that anyone in the NYSE community that's looking to add an independent director can have access to not only that database, but also the CEOs that recommended them and ask for those, get some color, because most board seats are filled that way. They're filled through referrals. There are 19 candidates from our database that have been placed on corporate boards to date since we've launched. And that's, 19 doesn't sound like a very big number, but it is a big number when you think about the corporate board profile and how it's changing. And the trends that we've seen, one of the reasons why we don't have a similar rule is we believe that using our regulatory authority to define the investable universe, which is really what we would be doing, is when, I talked about access to opportunity for investors. If we use our rules, we're saying investors, those companies can't be public, and those investors don't have access to them if we start to put too many restrictions on companies. So instead, we focus on solutions and transparency around the issues and try to change the landscape that way. And the market forces then will drive that behavior change. And that's what we're seeing happen. When we look at the data in the Russell 1000, there are, the vast majority of companies, 96% of companies have a woman on their board. 20% of boards are female for something like 67% of companies. So it's really shifting and it's changing, and it's because investors are demanding it, and that's where I think we need to go.
Yeah, but it's still a really slow process. Serving on some corporate boards myself, what is it going to take to get to the tipping point and really have huge changes?
It is starting to happen now, Reena. When you look at the development that we've seen over the past 12 months, and especially with respect to racially diverse boards and others, you're starting to see a lot of focus on new members being added that are much more diverse. And the conversation, California sort of kickstarted the gender diversity. So gender is ahead of racial diversity. And one of the challenges that we've had is not a lot of companies are reporting. So I know some elements of the NASDAQ rule are around disclosures and reporting. And we support, for sure, providing more information so investors have the tools that they have. In fact, we provide that data to investors. So as ICE, we are one of the largest ESG data providers. And a lot of data is around diversity and what board profiles are. And so that investors can not only have access to the data that's being published from companies, but also what's not being published from companies. And they are putting pressure. And money talks, Reena. You want to see things change, it's got to come from the investors. And very often, I frankly think it's been a convenient place to say the SEC or the exchanges should set parameters. The investors, if they want to see the change that they're saying they want to see, they have to talk with their dollars. And that will drive change faster than anything else, and that's what we're seeing.
Yeah, so turning to the E, again, you had a post on LinkedIn talking about how the E, the environmental carbon emissions, is being discussed on earnings calls so much more these days. Where do you think we're going with the E part of ESG?
Certainly. I mean, right now, the COP26 event is happening over in Glasgow, and there's a lot of talk from corporations, governments, and others on what steps do we need to take to preserve our natural assets. And so that's certainly a big area of focus for companies, and they're talking about it more because investors are asking about it more. And I think that's, again, a sign of where the dollar's going. If you look at a report that came out from the time period from 2018 through 2020, the percentage of professionally managed assets that are invested in ESG strategies grew by 42%, so that in the United States, 1 in every $3 of professionally managed dollars are invested in an ESG strategy. Companies recognize that if they want to attract those assets and those dollars, they need to tell their story. And so that's one of the things we spend a lot of time with our listed companies on, is how do they tell their ESG story? So we give them that data so they can see, this is what investors know about you. This is what they know about your peers. One, is it accurate? Do you need to fix anything that you're saying publicly? You'd be surprised by how many companies didn't realize they had an old website that had stale information, and investors were thinking it was up to date. And so being able to update that, and then also looking for their vendors and their suppliers, all of that drives the ecosystem change. And so there's certainly a lot of focus on the environmental aspect within ESG, and that's good because we need to do that. And I talked about our approach and solutions-based, and I mean that's why we've looked at what other things can we offer to help expedite this process, and we announced our plans to list natural asset companies to do that. So for companies that have the rights to ecosystem services, think clean water, rainforests, all of the things that are really critical to our living and surviving, they can list those as a company. So investors can say that they want to invest in those services. And it provides a solution where we can bring together companies, governments, and investors to drive the meaningful change that we need to see. And so that's an approach we'll take time and time again in order to make the difference and have the impact that we want to have more globally. And the power of our community is why we're able to do it.
So is this what you're doing with the intrinsic exchange?
It is, yeah. So Intrinsic Exchange came up with a innovative way to account. How do you value those services? So we all say priceless, but they're not really priceless. They have a value. And so what Intrinsic Exchange Group did was come up with an accounting framework to be layered on top of GAAP accounting so that these products can be listed as companies. We'll file with the SEC to list new listing standards specific to those. And it gives investors an opportunity to say that they want to reinvest in the preservation of those services. And so it would be a new type of listing, a new asset class entirely, but it's a solution that brings together those that want to preserve our future and give them a way to do it and invest in it and put their dollars where they want to see action.
I can keep asking you many, many more questions, Stacey, that the audience is interested in, but I want to make sure we get in a few questions from our students here, from our Georgetown students. So I have Alyssa, Lucrezia, William. They're asking kind of similar questions from, what does a day for the president of the New York Stock Exchange look like? What do you love about your job? What's the most stressful part? So these questions are about your daily life.
So you never know what a day is going to look like. Even when you get up in the morning and you look at your calendar and you see what's lined up, you never know if that's really what it's going to be, because markets are alive. And so they can throw whatever they want at you. But it might include welcoming a company to celebrate a milestone or an IPO. When you ask my favorite part, it's so much fun to see the companies that are, they've invested so much into going public, and when you're celebrating that moment with them. I love it even more when they come back to celebrate a milestone or an event 10 years later, 5 years later, and you're seeing their growth. I mean, it's really almost like you're part of the family. So that is tremendous fun. And it's a lot of, it's very inspirational. People think about Wall Street and corporate America and all those things, and very often think of it as if it's about making the rich richer. And that is not what it's about. It is about changing the quality of life for people around the world and bringing people together by bringing assets and investors with companies, with ideas and dreamers and entrepreneurs. You can literally change the world. And so I love that and seeing all the ways they're doing it.
The other set of questions are from Tommy and Ed, and they're asking, how did you pivot from engineering to finance? And the women are especially asking, you are inspirational to them, and so they're asking, what advice would you have for them?
So engineering to finance just happened. I was studying engineering. I loved it. I enjoyed it, I would say. I really found the classes interesting. When I came to the trading floor, I fell in love with it. And I felt different to me. I was very passionate about it in a way that was just a little bit different from my engineering exposure. And so my advice to all students, expose yourself to as much as you can, because you will find your passion and you might not know that it's out there. It can surprise you. My advice to women in particular is that recognize the fact that what's different about you is what makes you more valuable. And diversity of thought is so critical. So don't walk in a room, be intimidated, and try to fit in. Share your opinion. Think about what you're hearing and provide your perspective, because your perspective is going to be a little bit different. Everyone's perspective is a little bit different, and that's what is so valuable about diversity.
And then there are questions from Zamana and Ben and a few others about the automation in the financial services industry. Do you ever see a point where human traders and bankers become obsolete?
So this is a great question, and really timely too, because we think about what we saw during 2020. We had to close the trading floor. And so we know stocks trade better on the New York Stock Exchange, but we didn't know how much of our outperformance comes from the model that we put in place that includes more accountability from our technology that underpins it, or from the actual human element on the trading floor. And because we had to close the floor for 9 weeks, we could actually measure it. So it was the first time that we could see, because we still had the accountability and the model was the same, still had the technology, but we're just missing the human element. And what we saw, and actually an academic took the opportunity to study it as well, and saw that our stocks didn't trade as well as they normally did when the floor was open, even though they continued to trade better than other markets. And so that shows that we're continuing to provide value. We believe strongly that bringing together the thoughtful integration of people and technology is so much more powerful than either on its own. And that's why we're committed to the trading floor, especially after what we saw in the pandemic. I mean, people were saying, you're never going to reopen. And what we learned was, oh, well, look, like this is why. It was a real validation of the model and continuing to keep the floor open.
Kind of related to that, one of the questions is price discovery and passive versus active. And is there any reason to be concerned about too much passive?
You're certainly seeing an area of growth. And again, markets are evolving. What's great about passive investing is it provides a simple tool for investors to exercise a thesis without having to manage all of that activity themselves. When you think about ETF trading, it provides access to a simple equity-style trading mechanism for more complicated products and services. We just launched the first ever Bitcoin ETF last week, and investors were waiting for it. Right? It hit $1 billion in AUM within 24 hours. So that is showing you that people want access in the wrapper that they're familiar with and that they understand in the equity markets. And there's more retail investment in the equity markets. So those are good things to provide more sophisticated tools to retail investors, especially as we're welcoming more retail investors into the market.
Stacey, thank you so much for joining us for the 13th Annual Financial Markets Quality Conference. We really appreciate your comments. Thank you.
My pleasure.